Welcome to the deep dive. If you are the kind of learner who, loves untangling a good corporate mystery, you are in the perfect place today.
You really are. It's a fascinating one today.
Right. Because usually when you pull up a company's stock chart, you expect it to act as a relatively accurate mirror of the underlying business.
Exactly. We're taught that the market is this perfectly rational weighing machine.
Yeah, if the business is printing cash and growing, the line goes up. And if the business is burning down, the line goes down. It's supposed to be clean, binary, and, well, it's supposed to make sense.
The market certainly loves to present itself that way. We naturally want to categorize things neatly into winning businesses and losing businesses, just assuming the ticker symbol tells the whole story.
But then you stumble across a scenario that completely shatters that mirror. Today, we're looking at a massive corporate paradox.
Oh, it's a total disconnect.
We're unpacking a situation where a business actually seems to be outperforming its competitors. They're boasting industry-leading margins, they're expanding their footprint, and yet their stock price has been absolutely decimated.
Yeah.
We are talking about a gut-wrenching 70% plunge.
The word for that is a market disconnect. And it's one of the most fascinating puzzles you can encounter in finance.
For sure.
It forces you to figure out how rock-solid business fundamentals and deeply pessimistic market sentiment can just end up inhabiting completely different universes.
And that is exactly our mission for you today. We are going to figure out how a company can look so brilliant on a spreadsheet, but so terrifying on a stock chart.
Let's do it.
The company in the spotlight is INDIGO Paints. To solve this, we've got two incredibly detailed sources on the table. First, we are looking at INDIGO Paints' official investor presentation for the third quarter of fiscal year 2026.
That one's dated February 13, 2026.
Right. Yep, exactly. And we are pairing that corporate ledger with a highly technical, deep-in-the-weeds news and chart analysis of the stock from March 2026.
Perfect.
Okay, let's unpack this because we have a business that looks like an absolute fortress, but trades like a falling knife.
To understand why that knife is falling, we actually have to step away from the financial statements for a moment and look out the window.
Look out the window.
Yeah. Before we evaluate Indigo's management, we have to talk about the weather and the calendar. The Indian paints sector over the last 2 years has been trapped in a brutal macro storm.
Literally a storm, right?
Literally, you've had unpredictable, heavily extended monsoons combined with festival seasons that arrived unusually early.
I want to pause there because for someone not intimately familiar with the Indian real estate market, blaming the rain sounds like a convenient excuse.
It does sound like a cop-out.
Right. Why does a longer monsoon decimate a paint company's revenue?
Well, it comes down to the physical limitations of the product and deep-seated cultural habits. In India, painting is highly seasonal.
Okay.
You physically cannot do exterior painting during a heavy monsoon. The moisture prevents the paint from curing, and it literally washes your work away.
Oh, wow. So you just can't do the job at all?
Exactly. So the entire industry pauses. And culturally, massive repainting projects are tied strictly to major festivals like Diwali.
Which is a time of renewal and cleaning, right?
Right. So when the monsoons drag on longer than expected and Diwali shifts earlier in the calendar, that critical post-monsoon painting window gets completely squeezed shut.
Ah, I see.
The traditional demand cycle doesn't just delay, it evaporates entirely for the year.
The homeowners just decide to wait until next year.
Exactly. They just cancel the project.
Man, that persistent, sluggish demand environment must be terrifying for the entire industry. And that macro headwind is violently reflected in Indigo's stock chart.
Oh, it's ugly.
The technical analysis from March 2026 lays out a grim timeline. The stock peaked at around 2,600 rupees back in September 2024.
Right.
By March 2026, it had plunged to an all-time low of around 770 to 800 rupees.
Yeah, a 70% destruction of value in 18 months. But, that requires us to look at the starting point.
Okay, what do you mean?
When Indigo was trading at 2,600 rupees, it was likely priced for absolute perfection. The market was assigning it massive growth multiples, assuming the good times would roll forever.
Oh, so there's a bubble.
Right. What we are seeing now isn't just the weather. It is a brutal multiple contraction. The market realized the sector is cyclical, the bubble popped, and the pendulum swung to extreme pessimism.
And the chart analysis gets very specific about that pessimism. It describes the price action as forming let me read this, it's a steep descending channel.
Yep.
And it points out a death cross. I mean, even just hearing the term death cross sounds ominous.
It does. Technical traders love their dramatic vocabulary. But if we connect this to the bigger picture, the mechanism behind a death cross is entirely logical.
Break that down for us.
It happens when a short-term moving average of the stock's price, usually the 50-day average, crosses below a long-term average, like the 200-day.
Okay.
It's just a mathematical confirmation that the recent downward momentum has overpowered the long-term trend. The moving averages literally fan downward, signaling that sellers are completely dictating the terms of trade.
Got it. The sources also point to something called a Manny histogram being deep in the negative, and the relative strength index, the RSI, sitting under 30.
Yeah, those are key indicators.
For anyone who isn't, staring at trading terminals all day, how should they visualize those?
Think of a stock's price movement like a car traveling down a highway.
Okay, I like car analogies.
The price itself just tells you where the car is. The MACD, which measures momentum, is the speedometer.
So a deeply negative MACD means what?
It tells you the car isn't just rolling backward. It has its foot firmly on the accelerator in reverse.
Ouch. And the RSI?
But the RSI measures exhaustion. When the RSI drops below 30, it falls into what's called oversold territory. It implies the sellers have been dumping shares so aggressively and for so long that they should theoretically be running out of shares to sell.
The volume patterns in the source material perfectly support that car analogy, actually.
How so?
Well, the data shows that whenever the price tries to rebound, say, a minor bounce back up to 900 rupees, the trading volume is incredibly low.
Right.
I look at that like trying to push a broken-down car up a steep hill. You can shove it a few feet upward, but because there is no underlying engine power, meaning no massive institutional buyer stepping in the second you stop pushing, gravity takes over.
And it rolls right back down to the bottom.
Exactly.
The lack of volume on the upside is the ultimate proof of apathy. The market sentiment is undeniably deeply bearish. No one wants to catch the falling knife.
But wait, I have to push back here.
Go.
If the chart is this catastrophic, if the sellers are this dominant, and the macro environment is an unprecedented 2-year slump, the actual business must be hemorrhaging cash, right?
You would think so.
Yeah. I mean, you don't lose 70% of your market cap if everything is fine.
And that is exactly where the financial realities in the investor presentation provide the ultimate plot twist of this deep dive.
Bring it on.
Because the business is not falling apart. Relative to the rest of the industry, Indigo Paints is actually thriving.
Thriving. Let's break down these standalone numbers for Q3 of fiscal year 2026 because they genuinely shock me.
They are wild.
Revenue from operations is 338.9 crore rupees. Now, for our global listeners, a crore is 10 million. So we are talking about roughly 3.38 billion rupees in a single quarter.
It's a massive number.
And more importantly, that represents a 3.5% year-over-year growth.
And context is everything here. The industry average growth for that exact same quarter was negative 4.4%.
Negative 4.4. Wow.
Yeah. The broader market is shrinking. Competitors are bleeding sales, and Indigo managed to claw out positive growth. That is a massive operational outperformance.
And the profitability metrics are even wilder. Their EBITDA margin, which is basically the cash profit they generate purely from their core operations, before taxes and interest, sharply improved to 19.4%.
That's up from 17.5% the previous year.
Right. And their PAT, their profit after tax, grew 11.2%.
I should note, the sources do mention that the profit after tax figure requires a slight adjustment.
Oh, what kind of adjustment?
Indigo had to book a one-time exceptional expense of about 5.85 crores. It was to cover gratuity impacts from a new draft labor code on wages.
Okay, but that sounds like a pure regulatory accounting headache, not a fundamental flaw in how they actually sell paint.
Exactly. It's entirely a regulatory adjustment. We have to report it impartially as a stated expense, but when you strip out that one-time legislative penalty, their core profit engine is humming beautifully.
So they're growing sales in a shrinking market, and they are significantly more profitable while doing it.
Yep.
How are they pulling that off when everyone else is, drowning?
The secret lies in what the company refers to as their pole position in gross margins. Indigo is currently sitting at a gross margin of 47.1%.
47.1?
Yeah. And to understand how staggering that is, the average for other publicly listed paint companies in India is hovering way down around 41 to 42%.
That's a big gap.
Indigo has a 500 basis point moat over the competition.
Let's translate basis points for the learner real quick. 100 basis points equals 1%. So you are saying Indigo has a full 5% advantage on their gross margins.
Exactly.
In a mature, highly competitive industry like paint manufacturing, a 5% advantage is an absolute chasm. How do they build that moat?
The presentation points to a fascinating dynamic with raw materials. During the pandemic, global supply chain chaos caused the chemical inputs for paint to skyrocket. Recently, those prices finally dropped back down to pre-COVID levels.
Oh, but every paint company on Earth got that exact same benefit, right?
They did. But Indigo's management played a very strategic game with those savings.
Did they just pocket the difference?
No, they actually used the cheaper materials to carefully fund increased discounts in the market. They were essentially buying market share from their struggling competitors.
Ah, smart.
But here is the brilliant part, because they maintained incredibly strict lean cost management internally, they still managed to expand their overall margins even while offering those discounts.
Wow.
They gave the customer a better deal, captured the sale, and still kept more profit per can than the rest of the industry.
Okay, but speaking of keeping the house lean, I noticed a detail in the Q3 numbers that immediately raised a red flag for me.
Oh, yeah.
Yeah, here's where it gets really interesting. Indigo's advertising and promotion spend, their A&P, dropped significantly.
It did.
It went from 8.2% of revenue in Q3 of fiscal 25 all the way down to 5.6% this quarter.
Right.
Are they just artificially juicing their short-term profit numbers by starving their long-term brand building?
Yeah.
I mean, if you stop advertising during a 2-year downturn, don't you lose massive mind share when the market finally recovers?
You are hitting on a classic corporate trap there. You generally cannot cut your way to long-term growth.
Right, that's what I thought.
Slashing the marketing budget to hit quarterly profit targets usually destroys the brand over a 5-year horizon.
So is that what they're doing?
Actually, no. The sources provide some crucial context that shows Indigo isn't just abandoning marketing. They are fundamentally shifting how they deploy those dollars.
Okay, how so?
The management specifically notes they are focusing heavily on BTL activities.
Let's define that. BTL meaning below-the-line marketing.
Yes. Above the line, or ATL, refers to mass media campaigns. Think massive television commercials during cricket matches or giant billboard blitzes.
The expensive stuff.
Exactly. Below the line, BTL is highly targeted direct-to-consumer, or in this case, direct-to-contractor marketing.
Give me a real-world equivalent for how that works in the paint business.
Okay, imagine you run a company selling premium olive oil. You could buy an expensive advertisement on the back of a restaurant's menu, hoping a diner sees it and asks the chef to use it.
That would be above the line.
Right. Or you could just walk into the kitchen and financially incentivize the head chef directly to only cook with your oil. That is below the line.
Ah, I see.
In the paints industry, the chef is the local painter and the painting contractor. Indigo is redirecting their budget to run targeted loyalty programs, direct training seminars, and specialized incentives for the contractors themselves.
So it's precision strikes instead of carpet bombing.
Exactly.
You convince the professional holding the brush to recommend Indigo to the homeowner.
And that is undeniably a more cost-effective way to drive high-margin sales in a slow market compared to blanketing the country in expensive TV ads when consumers aren't buying anyway.
That makes total sense. And the data actually supports that strategic shift perfectly when you look at exactly what products are driving their growth.
Oh, the product mix shifts are fascinating.
Yeah, I was just looking at the mix for Q3, and it paints a crazy picture, no pun intended.
Sure.
Their traditional bread-and-butter products are struggling, just like the rest of the industry. Emulsions, which are your standard water-based paints for broad walls, are actually down 3.4% in volume.
Right.
Butney and cement paints barely grew at 2.1%. But then you look at enamels and wood coatings, they exploded. We were talking about 20.2% volume growth.
That's huge.
And primers and distempers also grew over 7%.
What's fascinating here is the why behind that product shift. Standard wall emulsions are heavily tied to those massive post-monsoon exterior repainting jobs we discussed earlier.
Ones that got washed out.
Exactly. When the monsoon drags on, that category dies. But enamels and wood coatings, those are specialized finishes often used for interior woodwork, doors, and furniture.
Which means they are much less dependent on the weather outside. You can varnish a dining table or repaint interior trim even if it's pouring rain.
Exactly. Furthermore, wood coatings are premium products that require skilled contractors to apply properly.
Oh, which perfectly validates their below-the-line marketing shift.
You connected the dots. By targeting the contractors directly, they are successfully pushing the high-margin, specialized products that aren't weather-dependent, completely bypassing the emulsion slump.
They are finding the pockets of demand and just ignoring the dead zones.
Yeah,
That is brilliant.
it really is.
Okay, so that covers what they are selling. Let's talk about where they are selling it. This is honestly my favorite part of their presentation.
The physical footprint.
Yes. I think of Indigo's strategy right now like a really smart coffee franchise.
Okay, let's hear it.
Instead of just trying to open 50 massive, expensive cafes on the most saturated streets in Mumbai or Delhi where they would bleed cash-fighting giants, they're aggressively fortifying Tier 3 and Tier 4 cities.
And the physical footprint expansion in these smaller cities is driven entirely by their tinting machines.
I have to stop you there because the presentation boasts that they now have an army of 11,913 active tinting machines spread across the country. And those are supported by 55 depots.
A massive logistical network.
It sounds impressive, but how does dropping a paint mixer into a local hardware store actually move the needle on a corporate balance sheet? Is that really the secret to their growth?
It absolutely is, and it comes down to the brutal unit economics of a mom-and-pop hardware store in a Tier 3 city.
Okay, walk us through it.
A local dealer has very limited square footage and limited working capital. If they want to sell 50 different shades of blue, they traditionally have to buy and store 50 different cans of paint.
Which ties up their cash and clutters their shop.
Exactly. A tinting machine solves this. It allows the dealer to mix thousands of custom colors on the spot using a neutral white base paint and tiny drops of colorant.
So the dealer only has to hold inventory of the white base paint.
Yep. That frees up their cash and their shelf space.
It's a massive value add for the shop owner.
It is. But the strategic genius is the lock-in. Once Indigo installs their proprietary tinting machine in that small-town hardware store, that dealer is now buying Indigo's base paint and Indigo's colorants for the next decade.
Oh.
By deploying almost 12,000 of these machines, Indigo isn't just buying advertising. They are physically embedding their supply chain into the local hardware store's daily operations. They own the final point of distribution.
That is wild, and the sources show they just opened a new depot in Uttar Pradesh solely to enhance service efficiency for that growing network.
Yep.
Very unglamorous, nuts and bolts approach to stealing market share. But, Indigo isn't just relying on decorative house paint anymore either.
No, they recognize the need for diversification. The presentation highlights a subsidiary called Plunge.
Right.
This is Indigo's vehicle for tapping into the Indian infrastructure and waterproofing segment. We are talking about construction chemicals, concrete admixtures, and industrial waterproofing.
Which is brilliant, because infrastructure spending doesn't care about Diwali timelines.
Not at all.
If a new highway or commercial building is going up, they need construction chemicals regardless of the consumer mood or the rain.
And Plunge is delivering massive results. They grew an impressive 31% year over year in Q3.
31%.
Finding 30% growth in any subsidiary right now is a testament to identifying the right adjacent markets.
They're also building physical capacity for the future. The presentation details their manufacturing augmentation. The solvent plant in Jodhpur is already live.
Right.
And a massive new water-based plant capable of producing 102,000 kiloliters per annum is coming online by June 2026.
That's a huge addition.
They also highlight a putty brownfield expansion. Just quickly for the learner, a brownfield expansion just means they're adding new production lines to an existing, already operational factory, which is vastly cheaper and faster than building a greenfield site from scratch out in the dirt.
The timing of these factories is the critical takeaway regarding their operations.
I said that.
They are spending the money to build capacity and expand their depot network right now in the deepest part of the downturn. Management has explicitly stated they don't anticipate any major capital expenditures after fiscal year 2026.
Oh, so they're front-loading the costs.
Exactly. They are getting their physical house in perfect order today, so when the macro environment finally turns, they don't have to scramble to build factories. They will have the capacity and the 12,000 tinting machines ready to capture the upswing.
Okay, so what does this all mean? We have spent the last 15 minutes establishing that this business is a fortress.
It really is.
The margins lead the industry. They are dominating Tier 3 cities with brilliant unit economics. They are growing high-margin subsidiaries by 30% and bringing massive new factories online cheaply.
Yep.
Why is Wall Street looking at this flawless execution and shrugging its shoulders? Why is the stock trapped under 800 rupees?
It is the ultimate friction point between micro-execution and macro sentiment. When you synthesize the news coverage and the fundamental analyst reports, a very specific, almost contradictory narrative emerges.
Okay, what is it?
The analysts who actually study the spreadsheets love the company. They are forecasting a steady 10 to 13% annual earnings growth for Indigo moving forward. They have issued future price targets ranging from 1,430 up to 1,765 rupees.
Which would be roughly double where the stock is trading right now.
Exactly. Furthermore, management anticipates the upcoming fourth quarter to be even stronger.
Really?
Yeah, historically, Q4 is their peak margin quarter because the product mix naturally skews even further toward those high-margin enamels and premium finishes.
Right, because of the weather.
Yet, as the chart analysis showed us, the RSI remains firmly stuck under 30. The stock continues to be punished.
But why?
The reason is that the broader market, the institutional algorithms, and the big funds are currently trapped in a show-me phase.
A show-me phase. Meaning, the big money managers simply do not care about Indigo's internal metrics until the external weather report looks safe again.
That's it. In a modern trading environment defined by absolute information overload, markets frequently trade on overarching macro sentiment rather than individual micro execution.
I see.
The sentiment on the entire Indian paint sector is toxic right now because of the two-year slowdown.
Right.
Until those institutional investors see the broader sector demand recover to steady, high single-digit growth, they are fundamentally unwilling to reward individual company outperformance.
That's wild.
They see Indigo's 47% gross margin, but the only variable their risk models care about is the fact that the monsoon might be late again next year.
Man, it's like building the fastest, most technologically advanced, finely tuned cruise ship in the ocean, but nobody wants to buy a ticket to sail on it because everyone is terrified of a hurricane.
That is a perfect analogy. The market is entirely pricing in the storm. It is actively ignoring the quality of the ship. Indigo's management is targeting a growth rate 2.5 times the industry average as soon as demand recovers, with the explicit goal of hitting a 5% total market share.
That's ambitious.
The spreadsheet analysts see that runway clearly, but the daily trading algorithms are still fixated on the sector's current sluggishness.
This entire situation is a masterclass in business strategy for you, the learner, listening right now.
Absolutely.
Whether you are analyzing your own company's operations, making investment decisions, or just studying how elite businesses survive terrible conditions, Indigo Paints is executing flawlessly on the variables it can control.
They really are.
They are widening their margin moat, deploying tinting machines into untapped Tier 3 cities, acquiring adjacencies like Apple Chemie, and building future capacity. But they are completely suffering in the public markets on the variables they cannot control.
The rain, the broader sector sentiment, and the technical unwinding of a past bubble. It serves as a stark reminder that a stock chart is merely a voting machine measuring popularity in the short term, even if the underlying business acts as a weighing machine measuring real value in the long term.
That's a great way to put it.
But, looking at how tightly and defensively Indigo has managed this downturn, this raises an important question for you to ponder long after this deep dive ends.
Lay it on us.
When a business successfully optimizes its operations to merely survive, ruthlessly cutting mass advertising spend, leaning out internal costs, and squeezing every single drop of margin out of a brutal 2-year downturn, does it risk quietly losing the aggressive, risk-taking growth muscle that it is going to desperately need to capture the market when the good times inevitably return?
Oof. That is the million-dollar question right there. Can management flip the psychological switch from extreme defense back to aggressive offense when the weather finally clears?
We'll have to wait and see.
We will have to wait and see if the market's broken mirror finally repairs itself, or if the stock chart somehow knows something the spreadsheet doesn't. Thank you so much for joining us on this exploration of the sources today. Keep diving deep, and we will catch you next time.